Howdy, Jacob here. Today we're looking at Cadre Holdings in the machinery industry, 1.5 billion market cap on 1.6 billion enterprise value. Growth is not immense, but mid to low to mid single digit on the revenue side. Gross margin up a little bit, operating margin 12, 13%. Return on invested capital in the most recent years pretty solid, 12%, but average last 4 years probably upper single digits. Balance sheet has 88 million cash on hand, 12 million short-term debt, 128 million long-term debt. So a good amount of cash in relation to debt, and they have pretty great production of free cash flow. So definitely not concerned about that debt figure. Capital allocation is a little bit interesting. So they do have almost 1% dividend yield, and it pays out a 20%, 20 to 25% of free cash flow on the last 4 year basis. Outside of that, they've been issuing a lot of shares. They've been paying down a little bit of debt and then making some acquisitions. So it looks like majority of their money is going to acquisitions, into dividends. Majority of cases, my two least favorite forms of capital allocation. Obviously, there's a time and place, but not my favorite. As for assumptions go, probably comfortable with maybe 5% revenue growth, saying that they make some acquisitions along the way. Um, I don't know. I don't think they deserve quite a premium, so just below market average. Let's go 10, 11% for margins. I'm going to assume just 1%. That'll be their stock-based compensation, really. And then dividend, I can increase that with revenue growth, so it stays at roughly 20 to 25% payout. I mean, right now it just looks a bit expensive to me. No surprise, based on a 40p depreciating to 14, and then I mean, I just don't think the growth is really there. I don't think the growth is out substantiating the discount rate I'm looking for. So for me, I'm just going to be researching other stocks in the meantime. I hope you enjoy the video and have a great rest of your day. Thank you.